All right, welcome to today's Explainer. Today, we are going to dissect a totally fascinating real-world portfolio dilemma. We're looking at exactly why an investor recently decided to take their hard-earned capital and drop it into an aggressive, growth-oriented consumer stock instead of a rock-solid, established banking giant. It's the classic battle, right? Valuation versus growth. And we've got a fantastic breakdown to share with you.
Okay, so let's quickly run through how we'll break down this case study. First, we'll look at the S$6,000 portfolio dilemma itself. Then we'll unpack the company's multiple growth pillars and map out their strategic capacity expansions. After that, we'll dig into the hard valuation and revenue projections, talk about the upcoming bonus issue and dividends, and then wrap it all up with their long-term growth optionality. Let's get right into it.
Starting with Section 1, the $6,000 portfolio dilemma. This starts with a scenario that I think a lot of us can relate to when managing a personal portfolio.
Imagine having a final chunk of cash to deploy, but you're just completely stuck on market timing and valuation. The investor in our case study had about 6,000 Singapore dollars burning a hole in their pocket. This was reserved for a final chunk of DBS stock for the year. The original plan? Basically just sit and wait for the price to drop back down near their March entry point of $55.21. We all know this strategy, right? You're staring at a chart, waiting for that perfect, cheaper entry point to maximize your yield, only to watch the market completely ignore what you want.
And this perfectly illustrates the pivot. That dip that we're waiting for with DBS, it never happened. Instead, DBS posted really resilient first-quarter results and surged to a record high of $62.10. So seeing limited upside in the near term and flat-out refusing to overpay, the investor pivoted. Right around the same time, Food Empire dropped a better-than-expected first-quarter business update, and their price briefly retreated to around $3.01. That was the trigger. The investor confidently deployed that final $6,000 into Food Empire instead.
Moving to Section 2, unpacking multiple growth pillars. The big question is, what was the underlying business momentum that made Food Empire so compelling at that specific price?
Well, take a look at their 16.9% year-over-year sales growth for the first quarter of 2026. What's really cool here is how these trend lines show the group's multiple geographic growth engines firing all at once. They are absolutely not reliant on just one legacy market anymore. You can see these newly activated regions aggressively catching up to their older, traditional strongholds.
Let's actually break those numbers down because they're impressive. The undisputed standout is a massive 36.4% revenue explosion in Central Asia. That's being driven by a new Kazakhstan facility and some serious consumer pricing power. Then you've got Russia showing a 29.4% surge. Now, sure, that was helped by a 16.5% foreign exchange tailwind from the ruble, but the underlying organic growth is still incredibly resilient at 10 to 12%. Southeast Asia delivered a solid 7.5% expansion, mostly thanks to Vietnam. And over in India, their facilities are literally running at full capacity right now. They're providing a stable baseline today, but they're poised for a massive gross profit margin boost in the second half of the year thanks to dropping raw coffee bean prices.
Up next, Section 3, strategic manufacturing capacity expansions. Food Empire isn't just coasting on these current sales. They have a crystal-clear, multi-year roadmap for cranking up their localized production.
This sequence is absolutely crucial. In 2026, that Kazakhstan coffee mix facility is fully up and running and proving to be highly lucrative. Fast forward to the end of 2027, and India is set to complete a spray-dried factory expansion that bumps capacity up by 60%. Then the big one, in 2028, a massive $80 million freeze-dried soluble coffee facility comes online in Vietnam. Why does this matter so much? Because localized manufacturing directly slashes logistics and tariff costs, which structurally expands their profit margins across the board and further reduces that dependency on legacy markets.
You can visually track how this physical footprint is aggressively expanding across Asia all the way through 2028. It's not just about producing more coffee. It's about unlocking a massive revenue breakout while heavily leveraging factory automation. For instance, they're implementing immediate line automation in Vietnam as we speak, and they're steadily ramping up utilization of 2 brand new towers at their non-dairy creamer plant in Malaysia.
Which brings us to Section 4, valuation and revenue projections. Okay, we've mapped out all these operational drivers, but we have to ask the ultimate investing question. Is $3 a share actually a good deal?
To figure that out, we have to translate those capacity expansions into actual localized growth assumptions. Look at these projected revenue growth rates through 2028. Central Asia comes out swinging with 35% growth in FY26, tapering to 25% and then 15%.
Russia models at a really steady 15% per year. Southeast Asia hits 12%. South Asia, which is primarily India, stays flat initially because of those capacity constraints we mentioned, but watch it jump to 25% by 2028 once the expansions finish. And Europe offers a very stable 4.5% baseline.
Now, when you consolidate all of those regional projections and assume a normalized group net profit margin of 12%, which makes total sense given easing raw material costs and all that localized operating leverage, the group is tracking toward a highly reliable compound growth rate of 14 to 15% on both the top and bottom lines over the medium term.
So look at this number, 1. This single digit represents the forward PEG ratio. That's the price to earnings to growth ratio. Based on a trading price of roughly $3 and those incredible growth projections, the PEG ratio sits just a hair above 1. In the investing world, this signals a highly attractive risk-to-reward opportunity. It's like the market simply hasn't fully digested this potential for a company that has such a proven track record of surviving global crises and successfully diversifying its earnings.
All right, Section 5, Bonus Issue and Dividends. Let's talk about corporate actions. Specifically, how the upcoming 1-for-5 bonus issue is actually going to impact your total returns.
You have to look at the mathematical reality here because it can be confusing. With a 1-for-5 bonus issue, the headline earnings per share is going to drop by 20%. But at the exact same time, you are receiving 20% more shares in your account. Your proportional ownership of the company's earnings doesn't change one bit. Mathematically speaking, it makes absolutely zero difference to your intrinsic total return. But here is the real catalyst you want to watch: the dividend. If Food Empire hits their projected earnings, and the board decides to maintain their historical 8-cent ordinary dividend payout on that newly expanded share base, the total payout ratio stays at a highly manageable 53%. For you as a shareholder, that would basically be a massive de facto 20% dividend raise in real terms.
Finally, Section 6, Long-Term Growth Optionality. Let's look out beyond 2028. Because Food Empire has some structural drivers in play that give it immense asymmetric upside. This is way more than just a short-term trade.
The strategic importance of these new facilities goes way beyond standard consumer products. The massive expansions for spray-dried coffee in India and premium freeze-dried coffee in Vietnam will act as a huge multi-year tailwind for their high-margin business-to-business ingredients division. On top of that, they've got a strategic partnership with private equity firm Ikhlas Capital. That unlocks a huge runway for a massive distribution ramp-up all across the broader Southeast Asian retail ecosystem. The sheer scale of these catalysts should easily dwarf any future equity dilution from when their corporate convertible debt is eventually converted into stock. Bringing this all the way back to the portfolio level, the investor notes a really critical takeaway. You don't actually have to pick a side. While Food Empire offers the potential for a higher total return over the next 5 years, it's a consumer and industrial stock. It carries a higher risk profile. Because of that, DBS still remains their significantly larger core holding, providing that undeniable stability and safe yield.
Just look at this quote. Ultimately, the best outcome for my portfolio is when both continue to deliver and grow. This hits the nail on the head. It's a beautifully balanced, non-binary approach to portfolio construction. It acknowledges that aggressive capital compounders and major banking dividends both play completely different but necessary roles. You can cheer for your $6,000 growth injection while still relying on your core portfolio anchor.
So I'll leave you with this provocative thought to chew on in the ongoing battle between safe yield and aggressive compounding. If Food Empire executes its multi-year roadmap absolutely flawlessly, could it eventually challenge DBS's dominant position in a growth-focused portfolio? Thanks so much for exploring this investment thesis with us today, and we'll see you in the next explainer.